Welcome, everybody. My name is Paul Holden, President and CEO here at the Burnaby Board of Trade. And just before we get going, I'd just like to take a moment to recognise that we're here on the traditional homeland of the Hunkaminam and Skohomish-speaking peoples. And we're very happy to extend our appreciation for the opportunity to hold an event on this territory. In today's event, Pierre Cléroux, who's the Vice President, Research and the Chief Economist at BDC, Canada's development bank, will provide an overview of the economy here and abroad. So this will be a really interesting conversation. We're going to be learning how inflation, higher interest rates, and the resulting economic slowdown have changed our business environment. Before we start, I'd like to thank our annual partners, who are those organizations who stand out as top corporate citizens in Burnaby and who support our work throughout the year. And I think you can see their logos on the screen right now. So let's get underway with today's session. As we go through the presentation, if you have any questions, and I'm sure there are going to be quite a few, given the subject we're covering today, please enter those questions in the Q&A section at the bottom of your screens, and we'll save a few minutes at the end to answer those questions. So a little bit about our speaker today. I'm pleased to be joined by Pierre Cléroux, Vice President, Research and Chief Economist at BDC, Canada's development bank. Pierre was appointed to Vice President, Research and Chief Economist in 2012. He leads a team of experts who analyze economic data to identify business and sectoral trends impacting Canadian entrepreneurs. As a seasoned speaker, he regularly travels across the country to help business owners understand the risk and the opportunities presented by the economic environment. He is also responsible for providing economic analysis and advice to the bank's senior management team and supervises all the marketing and industry research activities. And we've had the pleasure of working with Pierre on a few occasions in the past. So looking forward to this today. So Pierre, I'll let you take over from here, and we'll be back for the Q&A.
Thank you, Paul. Good afternoon, everybody. I'm going to share my screen because I have a PowerPoint presentation that I would like to show you. So by now you should see my presentation. So what I would like to do in the next 20 minutes is basically to give you an idea of how the economy is going to perform in the next 24 months, in the next 2 years. In order to do that, I'm going to briefly talk about the world economy, focus on Canada and British Columbia. And at the end, I'm going to talk about one of the major trends or one of the major challenges that businesses are facing. We're going to talk about the shortage of labor. So the world economy, there's the war in Ukraine, but beside which is a very unfortunate and very important event, but beside that, the most important factor in terms of the world economy is inflation. Inflation is high in many countries around the world. Like we can see from this graph that it's over 10% in UK, close to 9% in Germany. So coming out of this pandemic, we had 2 years of recovery, and the recovery has been strong around the world, and inflation is quite high. And this is slowing down the economy. So the world, to fight inflation, interest rate has been increasing in different parts of the world. And as a result, the world economy is slowing down. We're not talking about the recession in 2023, far from it. We are talking about growth, but growth is going to be a bit lower than what we have seen over the last decade. So growth is going to be below 3%. And this is going to have an impact around the world, but including here, because when the world economy is slowing down, Canadian and BC export are slowing down as well. And we can see that most countries will have modest growth, and some countries will be even in a recession. That's the case in the United Kingdom, in Germany. Not only they're fighting higher interest rate, but also they have an energy crisis in Europe because of the war in Ukraine. So European countries are going to have a tougher time, especially that's going to be the case for the United Kingdom and also for Germany. In the US, high interest rate is slowing down the economy. We're not expecting a recession in the US. However, growth is going to be lower than what we have seen over the last 2 years. So Canada now. Before I talk about 2023, I want to come back to the last 2 years because it's actually important to understand what's going on now. The economy has been growing at a very fast pace over the last 2 years. 5% growth in 2021, 3.4% last year. And this is actually higher than the potential growth of the Canadian economy. So what does it mean? Well, you manage business, you own your own business, you know how much you can produce products or services during the year. So let's imagine that you did over your capacity for the last 2 years. So you produce more than what you are able to. So that's exactly what happened for the Canadian economy. We went over capacity for the last 2 years. And when an economy is overeating, two things is happening. The first one is, it's a good news, is we create a lot of jobs. And that's what happened in Canada. The Canadian economy has been creating 500,000 more jobs over the last 2 years. As a result, the unemployment rate is very low at 5%. So this is a very good news. A lot of Canadians are working. This is the lowest unemployment rate in the last 50 years. So this is a very good news. However, when the economy is running over capacity, that put pressure on price. For example, we all remember during the pandemic, a lot of people decided to make renovation in their house. Well, the demand for lumber has been increasing, so the price of lumber has tripled. So this is what happened when you put a lot of pressure, when people are, they have money to buy a lot of products, well, the price of everything is increasing. On top of it, we had the war in Ukraine that increased price of some commodities like wheat, oil and gas, and we had some supply chain disruptions that put pressure on price. So that was kind of a perfect storm, and that really had an impact on inflation. Inflation was stable before the pandemic, went up to 8%, the highest level in 40 years. The problem with inflation is has quite a negative impact on people, especially for people who have a low income or a fixed income. So imagine, but people, if you have a fixed income and the price of food is increasing by 10 or 15%, it's really having a negative impact on you as a person. And it's also difficult for business. I'm sure you have experienced more cost increase over the last 2 years. So it's difficult to do business when the cost of everything is increasing. So in order to reduce inflation, the Bank of Canada has increased interest rate 8 times in the last 12 months. So this is where we are. We're coming out of 2 years of strong growth. The good news is the unemployment rate is very low. There's a lot of jobs. The bad news is inflation is still high, and interest rate has been increasing, which is having an impact on the economy. So this is a starting point for 2023. So what should we expect for 2023? Well, the factor we're going to look the most is prices, because inflation is going to dictate interest rate policy. So that's the reason why inflation is very important. If inflation continues to increase, well, it means that the Bank of Canada will have to increase interest rate again. If inflation is under control, well, interest rates are no longer going to increase. So there's a good news. Actually, price pressure are easing right now. Commodity prices are back to the pre-war level in Ukraine. The war, of course, is not over, but the markets have adjusted. So, for example, the price of wheat is back to the pre-war level. The excess demand that we have seen over the last 2 years is gone. People are spending money, but the extra money that they saved during the pandemic is pretty much gone. Supply chain disruptions is also gone in most sectors. And finally, the job market is very tight. The unemployment rate is low. However, salaries are not increasing at the same pace. So if we look at the inflation, the 12 months inflation that you see in blue, it's down to 4.3%, which is really interesting. It's still too high, but it's much better than what it used to be at 8%. The red line is interesting. It's not a data that you see a lot in the media, but it's the 3 months inflation in Canada. So over the last 3 months, inflation increased by only 2%. So we can see that by increasing interest rate, inflation is actually going down. So the strategy is working. And this is important because it means that the Bank of Canada will probably not have to increase interest rate anymore. The prime rate is 4.5, and that should be enough to bring inflation down. It's working so far. That should be enough to bring inflation to the target rate, which is around 2%. So our forecast that you see in red on the graph is the interest rate is not going to increase. And by the end of 2023 or the beginning of 2024, the Bank of Canada should be able to start reducing interest rate as inflation is stable on the target between 1 and 3%. Because when you increase interest rate, like over the last year, you have a very negative impact on the economy. And we see it, consumers are paying more for their mortgages. This is the average monthly mortgage payment in Canada has increased by 22% over the last 12 months as interest rate is increasing. Half of Canadians have a variable rate. So each time you increase the prime rate, well, you actually increase the payment that these people are making on their mortgages. There's also another factor. More and more Canadians are repaying their debt faster. The blue line represents the mortgage debt payment, and it's really increasing. So people are using the extra saving, extra money to repay their debt faster, which is a good news. That's the right thing to do when interest rates are increasing. However, it's not a good news for the economy because it means that people are not buying as much goods, for example, or retail sales has been declining, which is not surprising. If people are paying more for their mortgage every month, well, they have to cut somewhere. And the way they cut is actually reducing retail. It's also having a negative impact on real estate. The volume of sales in Canada has dropped by 40%, and prices, the average price of a house, dropped by 17% since interest rate has been increasing. So this sector is very sensitive to interest rate, but there's other sectors that also are reacted to higher interest rate. That's the case of business investment. They are still elevated, but they are starting to slow down. And finally, our export has been sliding down as the world economy is slowing down. So the demand for Canadian products is not the same anymore. It's slowing down. It's still elevated compared to 2 years ago, but it's not increasing anymore. So if I try to summarize what happened in 2022 last year, everything was green, everything was growing, and we had growth of 3.4%. This year, as interest rate is increasing, we're seeing some red flags. Consumption of the goods is not the same, is going down. The real estate market is staying soft. Business investment and export are also slowing down. So what does it mean for the Canadian economy? Are we expecting that this will lead to a recession? Well, we don't think so. We believe that, yes, the economy is slowing down, but growth is going to be positive, slightly positive. Quite a change of what we have seen over the last 2 years. Some sectors are really feeling the increase of interest rate. That's the case of retail, real estate, some part of manufacturing. So, but we're not going to have a recession. We're just going to have a slowdown. And as interest rate is decreasing in 2024, well, we are expecting more growth in the economy and more momentum in the economy. One point I want to conclude on this graph is, we're not expecting a recession because this time around, the Bank of Canada is having much more control on the economy. The economy was not in recession before 2023, but we had too much inflation. So the Bank of Canada has increased interest rate to slow it down, which is very different than the two past recessions we had. 2008, you remember, financial crisis in the US that led to a world recession, including Canada. 2020, of course, was the pandemic, and that's created a really bad recession. But this time around, the economy is performing well. It's just because inflation is too high, interest rates are increasing. British Columbia economy has been performing very well over the last 2 years, and growth is going to be much more modest this year, just like because of the impact of interest rate. We're not expecting a recession, but growth is not going to be the same. And it's a bit like the same picture than for Canada. When you increase interest rate, people pay more for their mortgage every month. And in BC, you can see that's the green bars on the graph compared to Canada in dark blue. You can see that the level of mortgage payment every month is actually much higher. This is not a surprise because, of course, the price of housing is higher in BC than the average in Canada. But it means that when you increase interest rates, you have a bigger impact here. People are, they have to increase their mortgage much more than in other parts of the country. And this is having, of course, an impact on the real estate market. The real estate market is much more slow. The volume of sales dropped by 41%, and prices went down, but not as much as in the rest of the country. For example, in the great Vancouver area, from the peak, prices went down by only 7.5%. Remember, it was 18% for Canada. So the market, the real estate market, is much more resilient in Vancouver than in average in the country. In BC, the drop is actually 14%. In both cases, prices are still much more elevated today than in 2019 when the pandemic started. So we believe that this market is going to be much stable now. We don't expect more price decrease because interest rate is no longer going to increase, and also immigration is increasing. I'm going to come back to that. But immigration is going to support the real estate market. Another good news, well, the housing starts continue to be strong, and which is a different picture than for the rest of the country. In Canada, in general, housing starts have been declining as the real estate market is slowing down. But in BC, the supply of housing is really short. So builders are continuing to build houses despite the fact that interest rate is increasing. But we see the impact of an increased interest rate on retail. Retail sales dropped by 6% over the last 12 months since interest rate has been increasing. So you can see the impact of interest rate. People have to pay more for their mortgage every month, so they slow down on retail sales. Export is also going down, mostly because of lumber export, which is a big part of BC export. And the reason is real estate again. Not only the real estate market is slowing down in BC and Canada, but also in the US. So housing starts have really been slowing down in the US. As a result, we don't export as much lumber. So you can see that when you increase interest rate, you really have an impact on the economy. In BC, you have an impact on real estate, on retail, on manufacturing, on our export. So this is really the impact of increasing interest rate. But fortunately, there's going to be also some sector that will support the growth of the province, while some sectors are being impacted by higher interest rate. That's the case of business investment in total in expenditure. Every year we can see the numbers of investment in the province, and some large projects like the LNG project up north is really having a positive impact on investment, also on the economic activities. This project started 5 years ago. It's a $40 billion project. This is actually the largest industrial project in Canada. So you can see from the graph that when the project started 5 years ago, it really had an impact on the total number of investment in the province. And this is not over. It's a 10-year project. So despite the fact that the interest rate is increasing, well, this project will continue to support the economy of British Columbia. Another sector that is performing well is tourism. Tourism is back. This is the number of travelers coming from the US. You can see there was a huge drop during the pandemic, but 2022 was a much better year, and 2023 is expected to be an even better year. So I'm not sure if we go back to the pre-crisis level, but the number of people coming, international tourism is going to continue to increase in 2023. And another factor that is going to continue to support the economy is the fact that the unemployment rate is very low, 4.5%. This is below the Canadian average. And actually at 4.5, this is one of the lowest unemployment rate in BC over the last 50 years. So a lot of people have jobs, and it will continue to stimulate the economy, especially that people's revenue has been increasing. Salaries have been increasing. More people are working, more people have jobs. So the household disposable income has been increasing in the province. So part of it is going to go for higher interest rate, but not all of it, some of it is going to be spent as well. Finally, one final number that is quite interesting is the level of immigration is really increasing in the province. More people are coming from the rest of the country, but also from the rest of the world to British Columbia. This is important for the economy because it's supporting the growth, especially of the housing market. So despite the fact that the interest rate is slowing down the housing market right now, immigration is going to support the growth in the next few years. So as you can see, some part of the economy is slowing down because of a higher interest rate, but another part of the BC economy is going to support the growth. That's the reason why we're not expecting a recession, but a slowdown in the growth of the economy. And by 2024, when interest rates are starting to decline, well, the BC economy is going to pick up again and growth is going to be a little bit better. So I'm going to conclude this presentation by one trend that we're following is the labor shortages. A lot of entrepreneurs are asking me, where are the workers gone? We have a feeling that after the pandemic, a lot of people stayed home, and that's the reason why we have the shortage of labor. Well, actually, there's actually more jobs in the economy than ever before. In the BC economy, we can see that there's more jobs today than before the pandemic. There's more people working because the economy has been really growing over the last 2 years. So people are not staying home. They are just, there's so many jobs up there. That's the reason why it's difficult to find workers. But there's another reason. And the other reason is more what we call structural, is the fact that we have an aging population in British Columbia. 19% of people in British Columbia are older than 65. This is not unique to BC. In Canada, the number is very similar, but these numbers are much higher than 20 years ago. So the baby boomers that we have been talking for a long time, they are now close to 65. And when you're close to 65, what you do, you're retired. 42,000 people in BC left the job market in the last 12 months to retire. This is twice as much what we used to see in a normal economy. So this is a new phenomenon for Canada. This aging population means that more and more people are retiring. And unfortunately, this is not over, because if we look to the labor force, 22% of workers are now over 55. So it means that 22% of the workers are going to retire in the next 10 years. If you look at the graph, you can see this is way much more than what we used to see. We used to be only 10%. So this is what we call the aging population. People are getting older, and as a result, they are getting closer to the age of retirement. If I had to this graph the percentage of younger workers, people who are below 25 years old, you can see the problem we have. There's a lot more people ready to retire than people who are young and will take over these jobs. Again, 20 years ago, the situation was quite different. The percentage of younger workers was higher, but now the curves have been inverted. So the percentage of older workers is much bigger than the percentage of younger workers. So unfortunately, the shortage of labor that we see is going to stick with us for a while. So what is the solution? Well, there's no one solution. Immigration is part of the solution, and in BC, immigration is very strong. So that will help people to be able to find workers. But it's not going to be enough, and businesses will have to do their bit. Will have to change the way they're thinking about labor force, because it's going to remain difficult to hire people, and also salary will continue to increase. So in order to better understand what are the best strategies, we look at 1,500 companies and we look at what they do, their strategy, and also their performance, their financial performance. And we find that these 4 strategies that you see on the screen are the most beneficial one, the one that have the most success. If you want to have more explanation about those, I invite you to go on our website at bdc.ca. You will see the full report that we wrote on this. But let me talk about the first one. In the invest in technology and automation. Businesses who have been investing more in technology and automation, they are performing better than others because they protect their company against wage increase and also the difficulty of finding workers. Technology doesn't replace people, but it can replace tasks inside a company. Automation is the same. So you will see more and more businesses using automation because it will remain difficult to hire people, and also salaries are keeping increasing. So in conclusion, the Canadian and the BC economy, they are slowing down, and this is actually expected. The Bank of Canada wants to slow down the economy to reduce inflation. So in order to do that, they have increased interest rate very rapidly, 8 times in about 10 months. So it's working. The strategy is working. The economy is slowing down. Inflation is really going down. The good news is we believe that interest rates are high enough to bring inflation under control. So we don't expect any more interest rate increase. And by the end of this year or the beginning of 2024, the Bank of Canada should be able to reduce interest rate as inflation will be under control. So we're expecting not a recession, a slowdown in the economy for this year, and more economic momentum in 2024. Let me stop here, and I would be happy to take your questions if you have any questions.
Thank you, Pierre. Excellent. Thank you. Some really good information in there. Appreciate it very much. So let's. I don't see anything in the Q&A yet, but I'll keep mine that part of my screen open. But don't forget, everybody, please pop questions in for Pierre, and we can hand those over. Just expanding, actually, for something you were looking at near the end of the presentation, Pierre, in terms of the tactics that companies will be using in this changing workforce, and it certainly is changing. You look at those trends of the aging workforce and fewer younger people and what have you. The expanding the hiring pool was the last one that you mentioned, and I think that's something that we've been kind of advocating for and promoting for quite some while, because I think the days of a potential employer to just saying, okay, I'm going to post an ad in one particular place and that should do it. Nowadays, there are lots and lots of places where there are people very keen to join the workforce who are maybe not being approached.
You're perfectly right. And that's what we find in our research is, everybody would like to hire somebody who have 10 years of experience, but these people are very hard to hire right now. So we have to look differently at the labor market. So these people who have more difficulties to find a job, for example, young people out of school, they have a much higher unemployment rate. Of course, when you hire a younger person, you have to spend more time for training, but it's actually, a good way to grow your business. Immigration, it's still, the unemployment rate for immigrants is still higher than for Canadians. So that's another way to increase your workforce. And so we have to look differently at the workforce than we did in the past. We also have to better market ourselves. In the past, like you said, you just put an announce, you would get 100 resume and you will be able to choose a person from there. Now it's much more difficult. So you have to go where the young people are looking for job in social network, for example. So we will have to work differently to make sure that we can attract the people we want.
Yeah, and I think it's just one other question on when we're talking about this kind of subject. Obviously, the people's mindsets towards work changed a lot over the last few years. Much more focus on mental health and work-life balance and what have you. What do you see those impacts being on productivity levels? Will it improve them because people are taking the time to invest in themselves a little more? Will it improve those productivity levels? Or are there going to be some changes that we need to be aware of?
Well, you're right. The job market is quite different. A lot of people are working from home or at least a few days a week. And I think that is not going to change. I think that's the new reality. Research are showing that this didn't have a negative impact on productivity. Productivity is the same. And a very positive result of that, Statistic Canada just released a report showing that the number of women in the labor force is increasing because of flexible workforce, and especially true for women who have young kids. So the participation rate of women with kids below 3 years old is much higher today than even just 2 years ago. So the ability to work from home has attracted more people to the workforce, and I think that's very positive.
Thank you. Yeah, we've got a few questions coming in now, and a couple of comments, and I'll ask a couple of those. But there are a few comments I think that are coming in where we're looking at what we can expect in terms of what might be happening in the US and how that would impact us here, because obviously it clearly it always will. And obviously, and it seems a long way away, but it's not that long away that we're going to be heading into another election cycle. And if we're reading what we're reading, it could be quite an interesting one. Should we put it that way? You're not seeing that will impact anything here for quite some while?
Well, the U.S. economy is performing very well right now. The unemployment rate is 3.5%, so that's very low. The economy, they have the same issue that we do. Economy is running very quickly. Inflation is high. So interest rate has been increasing. Inflation remain higher in the US. So we are expecting that interest rate would keep increasing in the US compared to Canada, where I think we have achieved the level we wanted. So as the interest rate keep increasing in the US, this will slow down the economy. We're not expecting a recession, but probably the demand for our export is going to slow down. We see it in lumber, for example, where the real estate market is really slowing down in the US. So our export for lumber is suffering from that. Another point is important is our dollar is likely to go down because as interest rate is increasing in the US, not in Canada, the gap is going to put pressure down on the Canadian dollar. So the dollar today is at 74 cents. It should go down to probably 70 cents by the end of this year because of this gap of this between interest rate in the US and Canada.
Thanks, Pierre. I'm just going to go through the questions kind of as they've come in. From Hillary, what's the greatest difference between how Canada and the US, or maybe even the UK, are approaching inflation reduction? Are there any kind of effective things that are proving to be the most effective strategies? I know you've spoken about how Canada achieved probably what it was aiming to, the Bank of Canada. Anything you've seen elsewhere that we could learn from?
Well, the US and Canada has really used the same strategy, basically increasing interest rate, hoping that the economy will slow down, and that will reduce inflation. So in both countries, it actually seems to work. Inflation is going down, both in Canada and the US. Where the risk is a bit higher in the US because they don't have the same financial system than we do. As you know, in Canada, we have 7 major banks, very large, very diversified by region, by sector. So it's a very safe financial system. In the US, they have 12,000 banks. A lot of them are very small. A lot of them are very focused on one region or one sector. So when you increase interest rate, you increase the risk of difficulties in the financial system when you have so many banks. And we saw that 3 weeks or 4 weeks ago when the Silicon Valley Bank went bankrupt in the US. Yeah. The government in the US was very quick to respond, and the Fed as well. So the crisis was contained. We don't believe it's going to have a negative impact on the economy, but that's a good reminder that when you increase interest rates very rapidly, something could happen. And that's a shock that we didn't predict, but it did happen. So that's something we are going to watch for more in the US than Canada. The financial system in Canada is so safe that this could not happen here. But in the US, that's something when you increase interest rate, the risk of seeing some banks having difficulties could increase.
Yeah, thank you. I might jump around a little bit here because there's a few questions kind of expanding on this theme, and then I'll get back. There's an interesting question about AI, which I'll get back to. But what event will need or would need to take place for the government to lower rates to any kind of, I guess, noticeable degree? What will be the incentives to lower rates if the economy continues to run smoothly?
Well, it's inflation. When inflation is high, it has a negative impact on people, on business, on stability, because it's hard to predict. It's hard to invest as a business if you don't know how much you're going to pay for your input for the next 12 months. So in order to reduce interest rate, the Bank of Canada has to see inflation under control. And for them, under control means around 2%. So they have this goal of, between 1 and 3. So basically the average is 2. So when inflation is down at 2%, you will see interest rate slowly going down. And the objective is to bring interest rate to around 2.5%.
And you mentioned about the exchange rate and potentially that moving towards the end of the year between Canada and the US. Coming to one of the last questions that was posted, there are so many Canadian companies that buy goods and services from the US. What do you see the consequences of that dropping dollar being in terms of impacting the real cost and margins when it comes to doing business, particularly for small business?
When the dollar is going down, there's a good and a bad news. The good news is our exporters. When you export to the US, it's easier if the dollar is going down. The bad news is just what you said, is we buy a lot of products and even services from the US. So when the Canadian dollar is going down, it's more expensive. So that's the bad news. Also, a lot of Canadians are traveling to the US, so it's a bad news as well. But I think it's better than increase our interest rate to follow the US. Often people ask me the question, is the Bank of Canada forced to follow the Fed? And the answer is no. And it's actually not a good idea to follow the Federal Reserve, because if the Canadian economy is not running as well as the US, that's the reason why interest rates are increasing faster in the US. So I think the downside of having a lower dollar, it's better than keep increase interest rate, and this will have more negative impact on the economy.
Thanks. We've got a question on mortgages and allowing borrowers on variable mortgages to extend their amortization. I think one of the things that we're seeing and hearing about is even in BC and Greater Vancouver area, where some of the housing costs may have gone down a little bit, not tremendously, but a little bit. But obviously the costs of borrowing have kind of offset that, because your mortgage is going to cost more. So it's still no easier, particularly for first-time buyers. It's no easier to get into the market. Are you seeing any new kind of products that might be launched or innovations that the government might help out in that will help people get into that into the property market?
Not so far, but I think the government should get involved, because we have a shortage of houses in BC and also in Canada. And the government is making clear, the federal government want to increase the level of immigration. They want to double the number of immigrants just because we have a shortage of labor and aging population. So it makes sense. But if you do that, you need housing. And it's the situation is the same across the country. It's even worse in British Columbia. Prices are high. So we're getting a problem where affordability is a problem. So we need to build more houses. And in order to do that, we need to have better regulations. We need to make it easier for builders to build. So the government will have to work with the private sector to make sure that we have enough housing for all this immigration that is coming. So the housing market is going to keep going, because the demand will be strong, and as interest rates will start to decline in 2024, is going to improve. But we need more houses, and we need the government to step in to make it easier to build houses in the province.
It's a challenge, isn't it? Because we're looking for a lot of people to come here to help us with the labour shortages that we have, and obviously it takes time to build the houses and to get the market up. So you could find yourself in a situation once again where the demand is growing at an exponential rate and the supply is not keeping up, and we know what the outcome of that is.
You're perfectly right. And that's the reason why prices has been increasing. And we believe prices will continue to increase, because the demand, like you said, the demand is going to increase faster than the supply.
Yeah. Let's change gears a little bit, and we will get back to some of these economic issues in a moment. But somebody asked a question about artificial intelligence, and that includes everything we're hearing about, in the overall subjects of AI and chat GPT and all that kind of thing. What's your organization and your group thinking about the impacts of that on I guess on everything, but particularly as it pertains to the economy and the job market?
We're trying Chat GPT inside my group as economists. So we're looking at how this can help what we do. I think it's going to be a major change, and Chat GPT is only one example of AI that we're going to see in the next 5 to 10 years. It's going to make many jobs much easier to do because this kind of technology is eliminating routine work. It's going to change the workforce. I'm not too concerned for two reasons. First, we have more jobs in Canada than people. We have about 900,000 vacant jobs. So, we need help. We need immigration, but we need technology to help us to continue to grow our business, despite the fact that we have an aging population. Second is when we compare Canada to other countries, we have one of the most sophisticated, or more educated workforce in the world. So we are well positioned to take advantage of that because, artificial intelligence is just another technology that will help people to replace some of their tasks by technology. So we always need people, but people will have to work differently. So the challenge is the adoption of technology, but also is the training that people will need to make sure that they are able to use with this new technology that we don't even actually know yet, because in the next 5 years, you're going to see a lot of different software that are going to be helping people. And I see that quite positively. But the challenge would be to make sure that we adapt to this new reality.
And it's interesting. I mean, obviously, it has a huge amount of potential adaptations, but a lot of what we're seeing, certainly in these early stages of its development, are replacing tasks that would be, as I think you mentioned, would be tasks that maybe people don't want to be doing, and tasks that can make things more efficient. But I guess there's a danger that those are often tasks that there's a lot of people currently working in those areas of fulfilling those kind of tasks. Coming to those positions in a number of different ways. But it's a big job market. The fulfilling of tasks is a big job market. So again, that has its challenges, doesn't it? If AI finds it easy to pick off those particular roles.
You're perfectly right, but this is not new. Look at over the last 20 years how the job market have changed. For example, when you park your car in a parking lot, you used to have somebody taking care of that. Now it's all robotized. Even if you go to many retail store or drugstore, you can pay, with a robot now in many cases. So it's already, has been happening. Another very good example is, 20 years ago, we used to have people who type. Now everybody has their own computer. They write their own letter themselves. So the work has changed over the last 20 years, and it's going to change even more in the next 20 years. So we're used to this change now. It's just, I think it's going to be, the pace of change is going to be even bigger. But I'm not, we have been able to adapt, and we will continue to be able to adapt to the new reality.
And it'll require, and we've said this for many years, that across a whole range of different job areas, the retraining and upskilling component is going to be very important. But it's interesting when sometimes you might see in an established or traditional technology or job type, an awful lot of the skills required to do that may well be transportable to something that we currently see as being brand new. And it just requires a little bit less upskilling than perhaps people might think.
You're perfectly right. And also, there's some benefits to that. Internet is a great example where any business now can sell around the world. It was not the case 20 years ago. You had to be a very large business to export. Now, I met companies who right from day one, they were exporting because with a website, people have access to what you do. So this is an example of how technology has been great for smaller businesses. So I think AI has the same potential in a different way, but it has a great potential to help, to democratize actually a lot of things that we do.
Yeah. Paul has asked the question on here, and I guess it comes back a little bit to what we were saying, earlier about some of the things that businesses are having to do to change, either from a technology point of view or automation point of view, what they do. But I guess there's also a need to change what how you're training people to train for these skills gaps that we've just mentioned. Are you seeing much coming out that businesses should be aware of in terms of how they can get access to or learn about some of these new corporate training requirements and skills gap requirements?
Well, what we see is the businesses are training much more than in the past, because when you buy technology or sophisticated equipment, you need to offer training to employees to make sure that they are using the new equipment or new technology perfectly. Also, there's a new trend. Businesses are hiring younger people. So there's a lot more training required. We see that because of the shortage of labor. So often also, they cannot find the skills they're looking for in the market. So they will take somebody inside the business and train them to upgrade their skills. So there's much more training these days in businesses than what we used to see.
Yeah, thank you. And I'm going to kind of continue, I guess, the theme of change and gaps. We've got a couple of questions, one on emerging jobs that young people should be aware of, and what's important for businesses in terms of making changes to adapt to the new world. We're doing quite a bit of work ourselves in looking at the whole issue of workforce development, and it kind of starts in the K-12, doesn't it? It starts in making sure that at a young age that people are being educated, with a view to not just what jobs are available right now, but to what the future of work is going to look like. And you don't want kids at 7 years old fretting over the kind of job they want to get, but you do want that system, and then through the post-secondary, to be aware of what those changing requirements are, and I know they are. But what are you seeing in terms of how people are developing, to the question here, that what young people should be aware of and trained for?
Well, a lot of the jobs of the future are not even existing yet. But one trend that we see is technology. We use much more technology today than in the past, and this is just going to accelerate. So one skills that the new generation need is to be tech savvy, to be able to use technology, to be comfortable with technology. I would say even to like technology, to work with technology. And usually it's not an issue with the younger generation. It's a much more issue for people who have been around for a long time and on the job market for a long time. But that's what the younger generation will need. They need because the job is going to change. It's going to evaluate over the next 10 to 20 years. But what is not going to change is your ability to use technology to do your work.
Yeah, no, that's a good point, and I think it is interesting that we don't know what we don't know yet, and we don't know what's around the corner. And I think when we get to my kind of vintage, and you look back at how things were 20 years ago, the pace of change is not slowing down, and it's really quite something. A couple more questions on interest rates and what have you. Is there anything else, Pierre, that you might want to share with us, just in terms of some of the impacts that it's caused on wage pressures, on other cost of living pressures, and just expand maybe a little bit on what you've already touched on?
Yeah, I think this. I think this is good news right now, because last year inflation went up very, very quickly. The cost of everything increased very rapidly. It's much better now. It's still the prices are increasing, probably too high in food, but beside food, the rest, like clothing, everything else, the price are pretty stable now. So that's a good news. That's put less pressure on people and also on business. On the supply chain, we find that in most supply chain, prices are not increasing as much. So that's the first good news. The second good news is interest rate has been increasing very rapidly, but we believe, at the end of it. So interest rate in Canada will no longer increase, which is a good news, and will go down at one point. It's not going to stay high like it is forever, because you can see that at that level, it's really slowing down the economy. So this is doing the work. This is doing the job. So at one point, when inflation is under control, we'll see more interest rate decline. So this is not the 4.5 prime rate. It's not the new norm. It's just exceptional to bring inflation down. So that's, I think, another good news. So in terms of salary for business, unfortunately, there's a lot of pressure on salary because there's so many vacant jobs. We have a shortage of labor. So unfortunately, we're going to continue to have pressure on salary. But as immigration is increasing and the economy is slowing down, this pressure is going to phase out. It's going to go down. Like in 2024, we probably don't have the same pressure on salary. There's more people coming to work. So the job market is not going to stay as tight as what it is now.
And talking about pressure on wages, and there's a question that was posted about, some of the conversations we're all aware of right now of groups that are looking for increases in salaries to keep up with the cost of living. But of course, recently in BC, it was announced about the increase in the minimum wage, and we've often, when we're having conversations about that, we've often brought into that conversation that it's not just looking at what's the minimum wage as an individual statistic. It's the knock-on effect of a minimum wage throughout the salary levels. And what are you seeing as perhaps people's thoughts on right now? There's a lot of pressure being put on salaries to be increased from that minimum wage level. How's that looking going forward?
As an economist, I believe that we should let the market work. If you don't need a minimum wage to increase because there's a shortage of labor, salaries are increasing. Also, in a context where the Bank of Canada is increasing interest rate to slow down the economy, any government should not make an action that will go against that. For example, spending more money or giving money to consumers or increasing minimum wage. Because when you do that, you keep price increasing. So on the one hand, you have higher interest rate to slow down the economy. You cannot, on the other side, trying to push up the economy. You should let the work of the Bank of Canada or the central banks working, and inflation would go down. Inflation is already going down. So that's the best way for government to react.
Yeah, no, that's a good point. And it'll be interesting to see over the rest of this year what the local inflation rates are, because the conversation is now being based in the over 6% level, and it's going to change.
Yeah, it's already down at 4%. So, we have to be careful. Like as a businesses, when I know there's a lot of pressure on business to increase salary because people are saying, there's high inflation, but inflation is going down. It's going down rapidly.
The last question that's just been posted by Chris is on the subject of the working from home, and Chris has mentioned about the impacts on people who own and lease out office buildings. If people more and more working from home and companies are reducing their office footprint. And so we'll raise that question, but also I guess that leads on to the one, particularly in some of the downtown areas, which I think we're seeing across not just Canada, but in a lot of city downtown cores. What are the impacts you're seeing on this change in how people work?
Well, we see the change is mostly in very large downtown area, Vancouver, Toronto, Montreal. This is where people are not coming back as much. And the issue is commuting time. So if you have a smaller community, a smaller town where people take 15 minutes to go to work, we see that people are coming back to work. In major cities where people spend an hour to go to work, an hour back, that's where we see most people who are trying to stay out of the office. And it makes sense. I understand, it's why would you spend 2 hours commuting every day if you can do the same job at home? So this is where we see the impact on office building in large downtown area like Vancouver, Montreal, Toronto, we also see an impact on businesses because, this flow of people that used to come, they used to shop, they used to go to restaurants, and now you don't have as many people. So the downtown area are still suffering from that. It's going to come back over time, but this is going to take some time because before we see vibrant, big downtown area in Canada.
We mentioned earlier before the webinar started about some of the societal impacts of people now being remote and being all over the place, and people saying, we're hearing from a lot of people saying, it's so great you're doing these events in person again, such as a big one we have tomorrow, because people are not having those chances to gather in those kind of numbers in the same way they used to.
You're perfectly right, and people need to gather. I see that everywhere. People, it's normal to build relationships. So if you don't go back at work as much, maybe you're looking for events like the one you have tomorrow, and that's good.
Yeah, exactly. Well, thanks a lot, Pierre. I think we I'm hoping that everyone who posted a question, we managed to get to that question, even if it was grouped in with another one. So hopefully we managed to do that. I appreciate your time again, Pierre. It's been great to catch up and to hear from you.